8:30 or just after 8:30 in the morning somewhere. And we are going to focus on what we always focus on. We're going to focus on investment. We're going to talk a little bit about growth. Today, I know we want to have it as more of a Q&A session, and we want to focus on what is it that actually is one of the most important things in the market, which is timing. And timing itself is like kind of a big fluffy word that doesn't mean that much. But I want to talk about timing, and I want to talk about also what are you trying to achieve and how are you trying to achieve it? And what's the timing of your growth and how fast are you growing or what's happening, everything else. So I want to touch upon tons of things. As usual, last week we had tons of people who had lots and lots and lots of questions. The questions are what make these restreams really work. So please pepper me with questions, whatever you want. If it's regarding your own specific startup journey, put it into a question, and I will happily answer it as much as I possibly can. I want to, as we're going through this, I want to refer to as many things that are happening in the Dojo ecosystem with startups as I possibly can, so that you're just really well positioned to be able to bust through and say, I learned from that and it really helped me, and now I'm going to do this. Okay, so let me start with the call. I'm going to work my way backwards from today so I can actually share with you some interesting things that are happening. So I'm going to start with a call with one of our companies, which I had an hour ago, and that company was they're going to do about $2.5 million, $3 million this year in revenue. Last year, they did about $2 million. And next year, they're due to do about $4 million. They, in their case, are growing too slowly. And they're growing too slowly because their competitors are growing faster. And even though as a startup, you may think, oh my gosh, this is great. They're actually growing, Brian. Come on, give them a break. 50% growth, that's okay. 70% growth, that's okay. In their case, because of the type of product they have, they need to be growing faster. And they need to be growing faster because they in particular have been around for about 7 years. And the challenge with a 7-year company is that when it comes to VC, it scares them. It doesn't mean that you can't be successful. It doesn't mean that people can't make a ton of money from you. It just means that to this point, you have disappointed investors because they've had their money tied up for 7 years and the valuation hasn't really moved that much. Because if they're $2.5 million in revenue, in their case, the valuation is probably somewhere between 12 and $15 million. Well, what's the problem? The problem was 3 or 4 years ago, the valuation was $10 million. So if we look at a future IRR scorecard for investors and maybe adjust it a little bit, we're taking a company that over 5 years or 4 years has had a 50% increase in valuation. Well, if you break that down to the year, maybe it's like 10%, then you adjust it for inflation and everything else, then you're talking about 6 or 7%. You're better off leaving your money in the bank, or buying Bitcoin, or doing any one of the 100 other things that you could have done that would have made you put your money into a much better place. That's what you have to look at. Remember, in the olden days, and I'm talking 2021, investors looked at stories, at ideas, at things that you were solving, at a better world that only you could create. They're not looking at that stuff anymore. Right now, they are looking at how to build monster companies fast. Everything is about future IRR. It's actually so relevant and so important that at Expert Dojo, we're building out scorecards so we can measure our companies against each other for their future IRR. We even have a name for it. We call it a B Fair score, right? B is boosted. Fair is future adjusted annualized investor returns. And I know that's not how you spell fair, but it's pretty close. So we still get to call it a B Fair score. And so you should be looking at this yourself. And that adjusted is, we look at the future IRR, which is part of that future investment returns. and that future IRR is, what is your valuation today? What is your valuation going to be at your next significant round? And there has to be logic about how you get to that next significant round. What is the time period between now and that period? So maybe your valuation today is 10 million, and your valuation in 2 years' time is going to be 30 million. Well, that's cool. You got a 200% increase, which is a 200% IRR if it was 1 year, but because it's 2 years, it's 100%. Then we'll adjust that and we look at things like, what was your revenue increase over the last couple of years? If it's 200%, then there's no adjustment. If it's less than 200%, there is an adjustment. Then we look at what's your revenue increase this coming year. If it's 200%, no adjustment. But if it's less than 200%, again, adjustment. And then we look at like revenue to valuation, and then we have about another 10 or 12 criteria for adjustments as well. And all of this gives us a likely future internal rate of return. And this is because all investors are looking at all of their assets today, especially in this very, very difficult market that we're in, and saying, how do I make sure that I maximize the return from those assets? That is the whole game. And that's the game you've got to start playing. And if you are a founder that is still looking at what you have and saying, I have a great company, which has got a great team, which has got a great product, and we're solving this huge problem. It's like, it's okay. But that stuff is game stakes these days. Like, it's expected that if you come into the poker game, that you know how to play poker. But the objective of the game is for you to win money at the poker game and not for you to lose money. And so think of you at the poker game as your investor. That investor has to feel that the probability is on their side in the poker game and not on your side. Sorry, not on the side of the other people playing poker. Okay, you get the idea. So measure this stuff out. Reduce risk for people. Show them how you're going to build the growth, which is going to drive the revenue on top. I had a conversation with a potential limited partner for Expert Dojo also today. Same principle, exactly the same. Everything was about us showing them how they could get return. And what we were saying is, look, we're early, so it's going to take you longer to get a return, but we're going to get a much better return. So you're going to get far better returns for your money than you would have got by just putting it in a thing that you would have used yourself. That's the game. That's all we're all doing. We have to be able to show that. And the timing of this market is very important. The timing of how long it's taken you to get here is very important. The timing of what you're going to build going forward is very important. And the timing of the investors who are around you is also very, very, very important. Okay, nothing else matters except you building out the large. And by the way, before I say this, I'm talking about venture backable founders. If you're a normal founder with a great company that you're growing and you're bootstrapping, take as much time as your cash flow will allow you to take. That's it. That's your only rules. And your family, maybe your wife, your husband as well, or your boyfriend, your girlfriend, your mom, your dad, whoever it is that is affected by the decisions that you're making other than yourself. If you're a lifestyle business, that is all you focus on. And if you're getting returns of 5, 6, 7, 8, 9, 10%, God bless you. You are doing an amazing job. I am talking about venture backable businesses. These are businesses that investors are putting money into with the expectation of a better return than any other place that they could put money into, right? So this is a good thing for investors, but you got to give them the returns. And it is so often at Expert Dojo now, we have over 300 investments. We got a lot of investments. And it is so often that we will deal with founders and they almost speak to us with surprise when we're talking to them about the fact that we would very much like them to start treating this business like a venture backable business soon. They're very surprised. right? Because that reflects where they are. But from our perspective, that's all we're looking for. So, what are other things that we're seeing in the market today? Like, first of all, there's a huge amount of hustle, much more hustle than we're seeing before. Even me, I'm going to travel over to Hawaii tomorrow so that I can meet with an investor, but I'm back on Wednesday night, technically Thursday morning, right? Why? Because we got to do what we got to do. There's no way around this. I'm also seeing much more founders building up their personal profile, their personal domain authority, so they can increase their company domain dominance in a far more aggressive way than I've ever seen before. I'm also seeing founders using the timing of this market, which is also not great for digital marketing. I'm seeing them focus on far more analog outreach campaigns. And when I say analog, it could be partnerships, it could be affiliates, it could be direct outreach, it could be building up enterprise and going after enterprise. It can even be arranging their own events. And so I want to share with you specific tactics that we're bringing in for like one of the companies that we've got very, very deeply involved with. So you get a feel inside our mind as to actually what's working. So how early, but let me take a question first, because I like the questions when they come in. How do early stage efficiently manage their portfolio? I don't know what that means. Will you help us raise any further rounds? Stop it. As a founder, listen, Payush, please, I got to move you away from this. And look, a lot of people think like this because they watch, I don't know, Shark Tank or whatever there is on American TV for venture backable stuff. You may even be based over in the US, which is even worse, right? You cannot be focused on your partners being there to support you raising money. There is only one important investor, only one. Everybody else is a bystander. The only important investor is who? Your customer. That's it. That's the only investor that matters. So, Expert Dojo invests. Yes, we do, but that's just how we make money. If you care about us investing, then you are a lesser founder. The only thing you should care about is about your customer giving you more business. If your customer is not giving you more business, then not being able to get investment is absolutely a symptom of that. But when you have a symptom, you don't treat the symptoms, or at least you shouldn't. You should treat the core root of whatever is happening that is causing those symptoms. Grow, 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 grow. When you get me on these calls, you're not getting some boring VC who's going to talk to you about your probability of raising and will we invest afterwards. I mean, the fact that we do invest afterwards, I don't even want to talk about, because that's not what's important. What is important is that you build this awesome, badass business, which is customer led. And what happens is this: there are tens of thousands of VCs around the world, tens of thousands. Every single VC is trained to do the same thing. Find companies that are scaling with a large market and a founding team who know what they're doing. Period. If you don't grow, you don't fit the training program. If you don't grow, you have to solve that problem first. If you do grow, investors will throw money at you. That's the game. That's how the world went from 12 unicorns to 1,260 plus unicorns. But you got to be focused on that game. Now, what I am not saying to you is ignore your investors. Not at all. They're part of the game. But what I am saying is you play the cards. Actually, let me rephrase it. You play the people around the poker table. You don't play the cards. Think of the cards as your investors. The people around the table and those poker players who play the people around the poker table, they're the great poker players. Everybody else is hoping they get two kings. They're like, come on. I got a king, I got a jack, and I got a two of hearts. Please, give me another king. Come on, come on, come on. I want luck. Give me another king. It's not a game. That's not what you're going to play. And that's not going to get you to be a unicorn. What you want to do is you want to look around the table and you want to see that kid over there. That kid has dropped 3 times with 2 aces because that kid gets ruffled when you push heavy. So I'm pushing heavy. I got a 7 of spades. Who cares? Wonderful. Now I can bluff because I know I can take the kid out. Play your customer. Always play your customers. That's all that matters. Okay. What have we got? Okay, out of the 10, how much pointers is for the timing in the business? Out of 10, how much pointers is for the timing of the business? I've seen businesses. You may want to elaborate a bit on that question, but if I understand you, it's like, how much does the timing of the business vary as far as it being from a level of importance? I think if you're pre-seed, then most of the people who are going to help you are people who know you, because they're going to base it on the timing of your life, right? They're going to say, I've seen Brian go. I've seen him sell. He's really good. He does these like sales seminars in these places. I think he could sell this product. And the product doesn't sound stupid. I've also seen like another product, which we really like out of India, which is a product which is like a pendant that like records all of everything that you're saying and then builds out AI agents, and those AI agents become digital twins in the future. Just really like that. And there will be people, even before customers, they will just find that what those people are doing is just dope. And so your idea definitely has cachet, and it definitely gives you something. And then as you go along, as you go forward, sometimes the worst thing that can happen to you is the thing that you wanted the most, which is to be able to get traction in your company. Right? It can be the thing that's the most terrifying thing, because it's like, oh man, sorry, but the traction's not enough, right? So you get your product, you put it to the market, you put it to your customers, and now your customers are going to give you feedback. And the feedback is it's not good enough. It's not cheap enough. It doesn't have enough value. It's not sufficiently functional. Like all these things that will like stop you from selling. And now it's more difficult to sell. Sorry, it's more difficult to get investment at this stage than it was before when you were selling an idea and a dream. What you got to do, you got to be able to get the customers to like it. You got to move fast to the next stage. There will still be people that will believe what they did at the beginning, but it becomes more difficult to convince them if they're more sophisticated. Okay, so I always give the same advice on this, is you start with the customer the day you think of the idea. The day you think of the idea. You're building up customers from the very beginning. You're building up partners from the very beginning. You're building up affiliates from the very beginning. And you're building up a feedback loop that tells you if you have a truly lovable product or if you just have a product which is kind of okay. Right? You just got to build the thing up, and you got to make sure that you're around that. If you keep focusing on the customer, but you also have a good feedback loop to let investors know the good things that you're doing. So for example, your journey is a 6-month journey. Week 1, you outreach to 3 investors. Week 2, you outreach to 10 investors. Week 3, it was a quiet week, 3 again, and so on and so on. By the time you get to the end of the month, you've reached out to like 35, 40 investors. Now you're going to do, 6 months. But what's happened is you've increased it. You did some outreaches, you did some emails, you did a couple of other things, and suddenly you're up to like 1,000 investors. So how do you keep those 1,000 investors updated as to the ongoing timing of what's happening in your business? Super easy. You have all these great social channels, right? You have LinkedIn, you have Twitter, you have everything. You have email, you have text. You have conferences that you can go to that you can speak about in a very clever way. You'll be like, hey, this is what's happened. I couldn't believe it. Our customers loved us. It was the greatest thing ever. And we put it out there and we just focused on them and focused on them and focused on them and focused on them. And we just improved and improved and improved and improved. And hey, ding it, we've got our revenue to $40,000 a month. And we expect to get to $120,000 a month by the same time next year, which is 200% growth. That's the way we're rolling right now. And hey, investors, you like 200% growth? That's how you do it. right? But you have to make sure they're all being touched with. What you do not want to do is the same boring, terrible monthly update that everybody sends out. Oh my God, I want to shoot myself. Hi, Brian. Here is 3 pages that you are never going to read about a bunch of criteria which you haven't asked for. And I'm even sending this because I need you to know all of the cool things we've done, even though the only thing you care about is how am I going to make you money? You don't need to do long updates. If you want to do one every now and again, no problem. But you don't need to do long updates. What you do need to do is regular updates. And you got to speak to people where they live. And this part of what you do is all about an area that I am terrible at, but we all need to get better at. And some people are really good at, which is systems. So let's see what you got. Good to see you, Alex. How do we support the founder when a perceived product market fit changes and the startup is working to revise? By the way, every single founder, including us, we're a VC, but we're a founder, right? We're all founders of something. All of us have product that will need to evolve in the future. Anyone who thinks that they built a perfect product to send out to market is absolutely stark raving nuts. It's impossible. We don't have enough feedback from customers. My expectation, it doesn't always happen, by the way, but it happens a lot. But my expectation is that most products will be somewhere between 35 degrees and 270 degrees different from where they started out. Sometimes it's an entirely different sector, entirely different industry, entirely different founding team, entirely different customer, entirely different ideal customer profile, entirely different offering, entirely different features. All of these things, it can very, very, very easily happen with. And so when you're building your perfect dream startup, remember, it's something that never existed before. You are going to develop this based on feedback, 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 and lots more feedback. And so you have to keep going back to your customer so you can keep on changing it. And I don't want to say the people who've got a 270-degree different product from where they started with are somehow better than the people who only have a 35 degrees different startup or who haven't changed at all. But it is normally the case that the more in tune with your customer you are, the more you're going to change it. Right? That's all there is. So that's what you should focus on. Get yourself a great product, build up a great product, make that product really feedbackable, create those loops with your customer, and then make sure that communication has always been aligned with the VCs. Remember, it's real simple. It's real simple. Even going back to the Be Fair scorecard that I gave you at the beginning of this for investors. Investors want a company that can do between 100% growth and 200% growth every year, period. Are you forgiven for a 0% growth? Yes, absolutely. Plenty of my companies have had a 0% growth because they're working out that product fit. They're working out that evolving product fit that Alex was speaking about. But you don't want to have too many years of less than 100% growth, because what will happen is it'll just take you too long to get there. So where is there? There is, if you're growing at 100%, from 30K a month, well, that's 60K a month, right? And if you're growing at 200%, well, that's 60K a month turns to 180K a month. And then if you grow at, that's 2 years. And say you're growing at like 100%, well, that 180 is going to turn into 360. So now you're on 360. And if you grow at 200%, then you have another 720 to add on to that 360, which is what, 1,080,000. If you grow at 100%, then the 360 turns to 720 a month. And you might say, but Brian, if we grew at 50% a few of those months, sure, absolutely. Look, most companies take somewhere between 7 and 10 years to be a unicorn. That gives you 3 years working out time. That's what you focus on. But you have to have those milestones in front of you, and you have to be aware that investors are in the same place. Because look, if an investor invests at $10 million and you get to $1 billion, well, that's 100 times, right? And if the company dilutes by, we'll say, 70%, well, then it's still a 30 times exit. And if the investor puts in $100,000, that's still worth $3 million. And that's how you have to look at it. But then the question becomes, well, hold on a second. It took me 10 years to get there, which is $300,000 a year. But $300,000 a year is still a 200% IRR. That's it. Your $100,000 gave you $300,000 a year. Thank you very much. $200,000 extra back, 200% future IRR, excellent results. Don't ever speak with investors with any other context than this context right here. Okay, and so let's see what you got, Bargav. How does Expert Dojo evaluate the growth for the 1 million investment? It's all growth hack. It's all growth hacking. So what we'll do is we'll build a warrant in for the company and we'll say, look, we're going to help you growth hack and we're going to build that around it. And based on us helping you growth hack, then you'll give us the option to invest $1 million in at a capped valuation in the future. And then hopefully we'll make the valuation worth 100 million, 200 million, 300 million, 400 million, like whatever it is. Like we'll build it up. Remember, your war here, your very specific war here is against time. Time is your greatest enemy. The longer it goes on, I had this myself with my own family, where members are saying, hey, you said the returns would be coming through earlier. What's taking so long? Do you think it's still working? Yeah, this is like a bloody, vicious, nasty, horrible trail, which is filled of the carcasses of VCs and founders who have tried to claw their way from pre-seed and early stage all the way to the elusive elixir that is a unicorn, right? That's what we're all doing. And no path is simple. The only paths that are simple are scam paths. Other than that, every other path is incredibly difficult. And so that's why when I sit with founders at the beginning and like we see the t-shirts and we see everything you're putting together, I'm like, come on, man. This is just one thing. It's just growth. You've got to be focused on growth. Forget the ego. Forget like being a CEO and how wonderful that is. This is grueling and tough and terrible and hard. And you got to grow. Nothing else matters. And so this is what we say to our companies. And even the celebrity fund that we built in the US is just to get another edge for those companies to be able to break through and be able to break through like in a bigger way. So yeah, okay, let me take that down. I can take that down. And so this call today, I wanted to just keep it straight and keep it simple and make sure that you knew what was happening in the market today. It's getting worse, but that's okay. There's still lots of investors out there. And those investors are still investing in lots of early stage founders. The timing of getting that investment is very important. The timing and cadence of how often you're connecting with these investors is very important, much more so than it ever was before. How your brand is built, your personal brand, and the timing of how long that takes is very important. You have to have a great personal brand to be able to get these people on board with you because they have to feel like they can trust you. And that's what your personal brand has been built to do. The timing of how your company evolves with the right people in your company is also really important for that first impression. It's funny. I was watching a podcast on the weekend and there was a great gambler out of Vegas, one of the top gamblers in Vegas. And they were asking him about tattoos. He had tattoos on his hands and his neck and his face, his eyelids and his forehead and everywhere. And he's like, I'm going to get rid of all of my tattoos. And they were like, oh, why are you getting rid of your tattoos? Your tattoos are really dope. And he's like, because there's literally no upside with my tattoos. Everything is a downside. And it's because what he realized was, as cool and hip and happening, as awesome as that person was, he realized in that moment that like the perception that he wanted to create for himself. And by the way, I always wanted a little Expert Dojo tattoo. And I'm sure I will get one in the future. So this is not about tattoos. This is about perception and how you align with the perception of the people that are around you, right? So I'm using tattoos as an analogy for how people will perceive you, and if that perception aligns with what you're trying to persuade them. So if you walk into a classroom, for example, and you've got tattoos all over your face and you're trying to teach kids, is the message that you really want to teach them going to be taken away from that? That's my only message about tattoos. I actually really like them. But so for you, that same perception is about your personal brand, where you're seen, how often you're seen, what is the timing of what you're actually putting out there, the perception about your business brand. How successful are you? In the moment that everybody looks at Expert Dojo and says, wow, you guys are an amazing fund, you're doing incredible things, you are dope. That is very different from if we lost 10 companies who all failed. And then people are like, oh, I don't know about that as Expert Dojo people. They're not very good investors. They kind of diligence a lot of terrible companies. I don't know. Okay, let me bring in a couple of, I'm going to bring in a couple more questions here. So if you have an AI copilot for sourcing founders who are actually going to scale, what would it need to look like? I don't know. That's a hard question. I'm so skeptical of one of the companies that we've got much deeper in is a data company, and I've gone down the rabbit hole in like a scary, crazy way. And what I've realized is that garbage in, garbage out. And most of the data right now most of the AI, I'm sorry, right now is reading garbage, which means, yeah, we're getting insights, but most of the insights are so far wrong because the foundational principles of what it's based on is pulling from incorrect material. So I think it's okay. I'm like, yeah, an AI copilot for sourcing founders. Sure. Like if this was late stage, by the way, I have a friend, Enzo, from Alpha Sigma, who's building up a really strong AI based trading desk. I'm down with that. Like, I think there's so much data and information in public companies that humans can't possibly go through that I think this is super significant there. But when it comes to like very early stage companies, some people are even pre-product. How can you tell which ones will break through, which ones won't break through? I'm not sure. I'm not sure that it's a thing. I hope that it's a thing, but I'm not sure that it's a thing. Okay, how do you differentiate signal from noise when evaluating early stage startups? What's broken in the process? You know, there's no differentiation between signal and noise for how people execute. And I've become very good at telling the difference between people who talk a lot and people who execute a lot. And so most products, if you ask 99% of VCs, do they invest in the products? They'll come up with something very banal, like, no, I invest in the jockey. But there is something to that because the execution power of the person who's there and the general roundabout idea of what they're doing is very important. And look, this is super relevant even in AI. Like if you look at OpenAI and look at how their product has evolved and continues to evolve over the next while, you'll see that like nobody's investing in OpenAI because they thought, oh, I'm going to build these models and then sell them to people. They invested because there was a bunch of very brilliant engineers who were onto a very interesting thesis about how the world was going to change and how AI was going to interact with that. And they had a very strong belief that they were the ones to be able to build out what was going to be the winning criteria. Okay. So I don't think it's evaluating early stage startups. I think that it's a very difficult thing. It's like trying to find young actors or trying to find young singers and young everything else. Sure, the voice you can tell, but everything behind it, like I remember in tennis, Jennifer Capriati, and most of you won't even hear from her. Great tennis player, but she fell apart and she had all kinds of things happening in her life that meant that she couldn't execute. So you want to make sure that you kind of push that as far away as you possibly can. Okay, a couple more questions. I'll do the last few questions unless somebody else has got something to put in. But again, what I just really want to emphasize on this call is sell, 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 sell. Just sell. Sell, sell, sell. Feedback, feedback, feedback. Learn, learn, learn. Sell, sell, sell. That's what you do. You just follow that loop and you're okay. I think following out, look, question here is from Kushi is how frequently should I reach out to the same investors showing my growth and the delta? You reach out about significant things happening. So if you're reaching out every week and I'm getting an email every week saying, I don't know, hey, Brian, I've just hired two more people. Okay. I mean, that's okay. I don't really care, but like, that's okay. Hey, Brian, we just did version 4 of our products. Yeah. I mean, I don't care, but like, it's okay. But Brian, you don't understand. We just added 10K a month to MRR, while previously we were only at like 25. That's significant. What happened there? Oh, hey, Brian, I'm glad you asked. Maybe you'd like to just hear a little bit about it because it was dope. I'm like, I'm down. So you just want to be like super relevant about like why it is you're speaking with people and you're reaching out to them and you want to have like a proper system in place for them. Um, I think we suck right now, Amrit, at this. And the question for folks just listening is how do we track founders we didn't invest in, but we keep an eye on them? Is that process working? I would say no, that process is pretty terrible right now. And I had a call with Ash this morning about how we build a very strong community that are staying super engaged with each other and with us so we can see companies as they're looking to grow. I think it is absolutely massive. Okay. Oh, I like all your questions, Amrit. That's good. Okay, signal noise, evaluating early stage startups, what broken in the process. Let's see what Alex has got. Thoughts on timing signals like product market fit, team maturity. Okay, so I want to finish with this because actually this is very good. And by the way, just before I come back to this, uh, just to make sure that I've answered Kushi's question properly, you can reach out to me every single day if it's significant, right? For me, I'm good at LinkedIn. Other people might be good at X. Other people might be good at Facebook. Other people might be good at text. Pick your poison with whoever your investors are and make sure that when significant things are happening, you're letting them know about it so that directly affects how they believe about you. So, okay, so timing signals like product fit. So, look, I have 3 separate phases when building a company: Viking phase, Gladiator phase, and then Knights of the Round Table phase. On your Viking phase, everything is just about outreach, 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 brand, 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 brand. You're trying to build a growth loop. That's what you want to do. You want to make sure that as you build that, you put yourself into a much stronger position going forward. The product fit, our lovable product, our value fit, or whatever you want to call it, is very much a part of that. And some people are super lucky and they get it really fast. Other people iterate their way there. And other people are like Slack. Slack wasn't even that product. Brex wasn't even that product. Like what happens is while they're going through their journey, they hear something, see something, find out something, and that moves them. And so you definitely want to make sure that you're keeping an eye on that. Now, as you come out of the Viking stage and you move into the Gladiator stage, which is the builder stage, the Gladiator stage actually has generally 80% different people than the Viking stage. Viking is just outreach, outreach, outreach. The Gladiator is about building this very highly sustainable and process-driven system around what you had already built. And you may have to rebuild a ton of other things as well. You do hire people at this stage, really good people. You also make sure that you're in a great position to be able to build, 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 build. And that growth loop has to be accentuated. Now, Alex, as you're going through this, and I'm talking about that lovable product, that product fit, like sometimes you're going to get it at the beginning. I know people though who haven't got it in the Viking stage. They just got like a partial product fit, but they knew they had to go for the full product fit to go all the way through the Gladiator stage. And then look, last stage is Knights of the Round Table. Knights of the Round Table is you're sitting around the table. Everybody around that table is better and smarter than you are. Okay, that's it. That's my 40 minutes for today. You have loads. You know what to do. If you are pre-Series A, go out there and be a gladiator, a warrior, a Viking. Go out there and find business, right? If you're stage two, which is on the gladiator side of it, I want you to build that business up and find ways to drive revenue on different revenue streams or the same revenue stream. I don't even mind. And then if you're in the final area, you know what to do with you when you're in the final area. Okay. So go out there, build a great company, drive great revenue, and then feed back to everybody. So everybody's feeling FOMO about not being a part of you. Okay. So see you here again, same time next week. Again, we're going to talk investment. Again, there'll be tons of content, whether it's me or whether it's somebody else who's joined us on these calls. And again, I'm looking forward to people coming back and showing us the incredible things that you've built